Well, good morning, guys. Can you hear me?
Yes.
Yeah.
Very good. I apologize for being a few minutes late. I hope that Victor told you that I might be.
Yes, he did.
So I just I need to share with you the experience I just had because I think it's instructive for you. Obviously, we're experiencing something together that virtually no one alive has experienced before. This kind of a pandemic and this kind of a business interruption is a function of a crisis like this. And so I was just in a session with 30 business owners that are clients at Goldman Sachs. And these people own businesses in the Intermountain area and in California. And they're looking at their businesses, some of which have gone to literally nothing in the last few weeks, and some of which have exploded because they happen to be in a business sector that is thriving in a crisis. And it's interesting to see how business owners are reacting to such extraordinary uncertainty. And I think that and I was in this, talking to them about how they need to forecast, and even though we're in uncertain times, not forecasting and not planning is simply signing ourselves to the wrecking heap and to business death. But it was very interesting to me to see some of the reactions. And I pointed out to you because you will have at some point in time in your business, whatever, whenever, wherever that is, whether it's one that you own or one that you're working on somebody else's, you'll have crises develop. Maybe not like this one, but nonetheless, there'll be crises. And you're going to find that those that survive and thrive during those crises, or that come out of them thriving, are the ones that put their head down, hunkered in, and worked their plan. Whether it was the best plan, you don't know in advance, because when times are uncertain, you don't know what the plan should look like, but they work a plan rather than simply succumb to paralysis. There were people on this call, I got to tell you, some of whom I've known for some time, there were people on this call that were crying because of the financial devastation that they're experiencing. And so it was hard, but if you don't do anything, you will die on the vine. So to the extent that I can share something with you today that goes beyond qualifying to get a good grade on a test, maybe that would be it. So let me bring up my sheets and such here so I can make sure that I know who's next and what we're dealing with. I'm pretty sure that Jaden, who had a pass last time, is up first. Is that right, Jaden? Okay, well, Jaden's telling us his computer's crashed. He's trying to get back on here. We're going to give him one more shot at this before we blame him for having strategized this as a creative way to get out of having to do something. Yeah, I can see Peter smiling because Peter's thinking, man, Jaden, you're smarter than I realized, man. If I'd only known, I could use that excuse to get out of having to give an answer to this deal. And bear with me just one more moment as I bring up the study guide. And then I'm going to go ahead and set it up so you guys can share your screens. Okay, so lacking our friend Jaden at the moment, we're going to actually move on. And Jaden, you're going to want to be ready for the next run here. So I believe that that leads us to Micah and question number 7. So Micah, you're able to share the screen as soon as you're ready to do so, or if you need to do so.
Okay, thank you. All right. Okay, so mine's doing the same thing that Jaden's must have done. It says I have to quit Zoom, and then I can come back on and put it on. I have to
Okay,
like reset my private.
so having learned from Jaden's successful dodging of a bullet, but only temporary, we'll go ahead and let you do this as well, but then come back to us quickly. Okay.
Yeah. I
Okay.
just have to cut it.
Very good. We're going to go ahead and move on to Noah as we do this. Do I see Noah? I don't see Noah. Noah, make yourself known. Well, this is such bad news. Okay. So I'm going to remind you guys that, and I'm doing this as much for the recording as I am anything else, but reminding you that you must participate in this to get a score for the final assessment. Paula, I see that you're with us, so we're going to go ahead and move directly to you.
Okay, I'll try to share my screen. I think it's here. Okay, can you guys see it?
We can.
Okay, great. So mine is question 13. Discuss the concept of the book value, market value, and the production value. The functional relationship between each and under what conditions we might expect the three to converge. So first I'm going to talk about the concept of the three values. So we can always find the assets book value on the balance sheet, and the firm's assets book value plus the goodwill equals to the firm's enterprise value, which is the price like the investor can buy this firm for. And the market value is the price that the asset can currently sell for. And the production value is the value calculated based on the cash flow that an asset can generate in the future. And in this class, we learn free cash flow model, KVD, or APV models can all calculate the production value. And then is the relationship between the market value and the production value. So people use the valuation models to calculate the production value, as we said in the last slides. And that is the sum of the present values of all the discounted future cash flows. And the market value should always be equal to the production value because the production value includes all the future cash flows that the asset can generate in the future. But while sometimes the market might add some premium or discount on the production value, so that sometimes market value might not equal to the production value. So an example to this is the house and mortgage rate. If people predict the economy is growing up and the mortgage rate is going down, so they assume more people will get loan to buy houses. So now people think the house price will be appreciated in the future. So now they are willing to pay more to buy a house. So that's just like a simple example about how market add premium to the asset's production value. And the relationship between the asset's book value and market value is that people can adjust the asset's book value to market value by applying mark-to-market method. And the mark-to-market method is that people take the asset's book value and adjust it to the market value. And the amount of adjustment will be the difference between the book value and the market value. And the market value here is the production value that we calculate from the models, or we can look at the similar assets on the market. And the little tip here is that firms must do the mark-to-market adjustment when their net income is lower than 15 million. And the last question is, when do the three values converge? The first case is that when the firm's buying the assets. So when firm buying the assets, the price, the value that the assets on the balance sheet will be equal to the market value. And as we said before, the market value will always be equal to the production value. So at this time, the three values converge. And the second case is that when the firm selling the assets, So the price that the assets sell for should be equal to the book value the assets have on the balance sheet. And the market value is still equal to the production value. So at this time, the three values converge as well. That's all.
Thank you. So Megan, I think you're the last one to have actually presented to us prior to Paula. Can you come up with a couple of questions for Paula, please?
Yeah, I think she did a good job. One question I have is for production value, is that only, like, what if the company is producing a negative cash flow, and does that give them a negative value?
What do you think, Paula?
I think the assets might keep their historical value since they buy it for that price, but I'm not sure.
Well, let's think back to the various models that we've looked at and the various cases we've dealt with. I think you've done at least a couple of examples where the firm is producing a negative cash flow during some or all of the explicit period, right?
Mm-hmm.
And in which case the sum of the present value of those cash flows is negative, but then we have the extension of the cash flows throughout the continuation. And I will tell you that if you enter the continuation period with a negative cash flow, you're clearly going to end up with a negative value, right?
Mm-hmm.
In which case, there should be no transaction. You know, Megan, if you've got a company and it's got a negative value of $100,000 and you sell it to me, that means you're paying me to buy your company. Well, that's not going to happen, of course. You'd rather just close it down than to have to bleed yet further still. So it's okay for some of the explicit period cash flows to be negative, but you must be able to get to a point where you're forecasting a positive cash flow in order to have a positive value. And if there is no positive production value, then there is no transaction that will take place. So I'm going to turn around and ask Paula, what is it that the company produces? So what kind of a company might you use as an example?
I would say the manufacturer industry.
Okay, so let's say they manufacture shoes. So from the perspective that we're looking at, what does the company produce?
Whatever they sell, the product.
Okay, and I'm going to tell you that from our perspective, yeah, maybe they make shoes to sell them to the marketplace, but for us, they produce cash flow. That's why this is called a production value. For us as investors and business owners, because a business owner is an investor, a company produces cash flow. Well, it might do so by selling shoes or by selling legal services or by renting out properties or whatever it does, but it produces cash flow. So that's why this is called a production value. And when Paula tries to bring these to a point of convergence, here's how I like to think about this. Production value should inform market value. So if I'm going to buy a business or an asset, and I'm being very rigorous about my assessment, I'm going to come up with some production value, and that's going to tell me approximately what I should offer to buy this for. So production value informs the buyer and seller as to what they should have in the way of a transaction. So it informs market value, or the price at which we agree. Production value informs market value. And then market value sets the book value. Because when Alex buys my business and brings it into Qualitative Enterprises, he's going to bring it into Qualitative Enterprises on his balance sheet at whatever he paid for it, which was the market value. And he knew how much he should offer to pay for it because he had a production value model, and what he was offering fit within the range of that model. Paul, you said something a few moments ago where you said if the market value and production value are different. Can you go back to that slide, please?
Yeah.
Which one? So while the market might add premium or discount on the production value we calculated. So think about this. If we agree on a market value, it's because our production value model has supported that market value. Now, it might support it at our discount rate, or it might support it at our projected revenues, but it might support it at a slight variations to those. And those variations form a range of market values, and which we then, a range of production values. And when we negotiate between buyer and seller and come upon a market value, what we've done is we've settled on a price within that range.
Okay.
So I feel those are all important elements when you're thinking about answering question 13. Any other questions or comments about this?
I have one, just like, so can we say that the production value is helping us to have the market value, or is it too simplistic?
No, in fact, that's a slightly different way of saying what I just said, Alex. Production value informs market value. Production value helps us know what market value should be. So you're exactly right.
Yeah.
Very good. At what moment in time would all three of these values be the same? Production, market, and asset or balance sheet? Book value?
When the firm buying or selling the asset?
Yeah, it's at the point of transaction. Because if production value informs market, that means I come up with a production value, and then I agree with Alex that we're going to buy a business at a certain dollar amount. Well, the production value and the market value at that point are the same number. And as soon as Alex puts it on his balance sheet, which is going to be immediate, then it's his book value. So at that singular moment in time, all three of those values are the same. They don't stay that way. They diverge virtually immediately. But at that one instance in time, they are the same. And if they're going to be the same at another moment in time, that's simply going to be coincidence. So all of this, I think, is a good set of points you might discuss in your answer. So let's go ahead and move on, and we're going to go ahead and pick up you, Micah. I don't see Jaden with us. So let's go ahead and pick you up.
Great. I figured out, I think the issues with it being recorded, the Apple computers are like really private. So they don't want you to be able to be recorded.
So if that's the case.
But it's okay. I had to just go in and like authorize it, but it should work.
Okay. Okay.
So are you seeing my desktop?
Yes, ma'am.
Awesome. Okay, so I had question 7, and it's, I would suggest that an enterprise value multiple tells us a great deal about the expected growth rate of a firm. Why do I think this? So to start, I just wanted to go over the enterprise multiple, and it's EV over EBIT or EBITDA. So EV is market cap of common plus market cap preferred plus market value of long-term debt minus cash and cash equivalents. Enterprise value is an indicator of the market value of the firm as a whole. It quantifies the total value of a company, including the company's debt, cash, and minority interests. In theory, this represents the total cost to buy a company. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's an important indicator of a company's operational profitability. It's considered a measure of the true cash operating profit of a company, since depreciation and amortization are non-cash items and taxes and interests aren't part of the operations of a company. So to answer, compared with other valuation multiples, enterprise value multiple is the most encompassing. The enterprise value multiple suggests what the expected growth rate of a firm will be, because the enterprise value in the numerator of the ratio quantifies the total value of a company, including a company's debt, cash, and minority interests. The denominator of the ratio, EBITDA, strips out debt costs, taxes, and accounting measures like depreciation and amortization, and gives the true cash operating profit of a company. If the firm has a high growth rate, you'll expect a firm to have a high enterprise value multiple. The true cash operating cash flow of a company could be multiplied many times before summing up to the value of the entire company, which is the enterprise value. The enterprise value multiple says what a company is being valued at per each dollar of EBITDA. If a firm has a high multiple, this means investors are willing to pay more for a dollar of the firm's EBITDA. If investors are willing to pay more, the firm should have a high growth rate, which means the firm will progressively earn higher returns and return more money to its shareholders. All right, that is all I have.
Paula, what would you have to ask Micah here? So I'm going to give you a moment to think. Micah, I'm going to ask you to release the screen because I need to share mine with you for a moment. And Paula,
Yeah.
I do want you to come up with a question.
Got it.
Thank you. Okay. So let me bring something over onto that screen so we can look at it together. Come on. I'm bringing up the valuation multiples quick sheet. I want to look at something here that's critical to answering this question. Are you all able to see the valuation multiples quick sheet? Good.
Mm-hmm.
So I'm going to focus right here on the one in the middle, and that's the EV/EBIT multiple that, or I think actually you were looking at EV/EBITDA. And Micah, everything that you said is accurate, okay? But there's something more that needs to be said here to really help us understand exactly why. Remember that this multiple, EV/EBIT, or down or over here just above it, EV/EBITDA, can be broken into an algebraic equation so we can see the inputs to it. And notice that G, or our growth rate, is the one unknown variable in this equation. We should know ROIC, we should know WACC, we know our tax rate, we know our depreciation rate, okay? So G is the only thing that we don't know. And you're right, when you tell us that the higher the enterprise value, the higher the growth rate, that's correct. And when you tell us the higher the multiple, the higher the growth rate, that's also correct. But the reason we know that's correct, in addition to what you said, is because this G, this growth rate, is the one dynamic within this that we are projecting, okay? Or that we have to calculate in arrears if we or calculate from the number. So if you see this question, then it's incumbent upon you to whip out one of these equations, because this is an absolutely necessary part of the answer. Include some of the qualitative commentary that Micah has given us, because it was rich and it was necessary, but also you're going to want to help me see the underlying algebraic component to this and see that G exists in this equation. And the higher the G, the higher the multiple. And so when I say that a multiple is a reflection of the company's growth rate, it's because of everything Micah said, and because I can see in the equation that G is a variable in the equation. In fact, it's the one variable that's dynamic. Paula, anything you have you'd like to ask or add?
Not really.
Okay, somebody was starting to ask a question. I cut you off. I apologize. I don't know who it was. No? Okay.
Rick, I actually have a question for mine.
Yeah, me too.
Go ahead, Micah, and then whomever else was trying to speak.
While I was doing some research on this, something that came up is that you don't want to have too high an EV over EBITDA. And I guess I was a little bit confused on that, because I thought like you wanted it to be high, but this was saying that too high is not good either, because it means the stock's overvalued maybe. But so I just was wondering if you could clear that up.
Yeah, there's actually two elements there. One is if you're acquiring something and the multiple on which you're acquiring it is too big, that means you're inferring a much greater growth rate than is feasible for the company, and you've paid too much, it was overvalued. So that's exactly right. But there's another element in here as well. Sometimes we don't want to buy into that kind of a company, not just because it's overvalued, but because its growth rate can't support, or it can't be supported by its internal capitalization. So if you're buying into something that's got this really high growth rate, as evidenced by its high multiple and its high price, then it needs to have a cash flow that can support that. Otherwise, you're going to have to go out into the market and raise cash. And we're going to have to raise cash at an undetermined cost, right? So that's the other reason for that. So I don't know who it was that was trying to speak, but someone was.
It was me. I think it was kind of like similar to Micah's question, but for the multiple, I think can you pull up the sheet that you were sharing?
Certainly.
Thank you. Because you said the higher the G, the higher the multiple, but you said also that hiring the multiple is just might come from like a better management of the firm, or just aiming for a multiple is just coming from the like the management or like whatever marketing. But is that in a relation with the G, or is that coming from something else, somewhere else?
Well, that's a good question, Martin. So let's make an assumption that you have a company and you are in a constant returns to scale construct, whether it's purposeful or because you've hit optimality in a market or you're just stuck there, okay? In which case ROIC will be fixed and WACC will be fixed, and tax rates we can't play with, and depreciation rates we can't play with. So what can you manage? You can manage your firm's growth. So when we talk about better managing the company, we're talking about managing the company for growth. I mean, who doesn't want their company to grow, right? Well, I know a particular class of company that doesn't want to. It's a company where the WACC is greater than the ROIC, in which case growth destroys value. So there we don't want to grow the company. In that case, we need to do something to improve our ROIC or reduce our WACC, okay? Both of which would be managerial exercises. So any one of these components of ROIC, WACC, and G can be managed. T probably cannot be. D cannot be. But ROIC, WACC, and G can. If you're stuck in a constant returns environment, it doesn't mean that you have to stay there. It's just that you need to bring the managerial strength to the table to get unstuck.
Okay, thank you.
Good question. Okay, so let's go ahead and move on.
I have a question, also relating the multiple ratio. Is it, can you, when you're looking at a company just purely based on the multiple, and then for instance the PE ratio, do they move in a sync with each other? So let's say we have a high multiple, high PE ratio, that might indicate to us that the stock price is overvalued, or if it's low on both sides. Can we use that as an indicator to us to see whether it's true or not?
That's a good question, Victor. So I'm going to turn that back to you guys. What do you guys think? Or would a high PE ratio and a high valuation, an enterprise value multiple, would those be positively correlated?
From what I was reading, they're not. I don't know if they're necessarily correlated, but I know they are interchangeable. Some people can use either one. I know more of a PE ratio is more evaluating a stock and whether or not it is overvalued. So an EV can be more valuing the company. So if I were to guess, I would say there is some correlation with them because they're both valuing like the value of the company.
Yeah, and I would agree. And you're right. They are similar measures, right? But they are applied to different instruments. So a PE ratio has to do with earnings per share and price per share, and that's got to do with the common stock almost exclusively, whereas an enterprise value multiple is for the whole company. And but they are positively correlated. Think about it. Cash isn't what's going to be changing in value. The debt's not going to be changing in value. The only thing left is the equity or the stock. So that's what's going to be affected by growth, right? and ROIC. So if you've got a high valuation multiple, enterprise value multiple, you would also have a high PE multiple. They're positively correlated, track very nicely together. Okay, so Noah, I see that you're with us and need you to come off mute and try to let us see your pearly whites, brother, so we can have you present to us.
Hey there. Yeah, unfortunately I haven't. I've been feeling pretty under the weather the past couple days, but so I haven't had the time to make a little PowerPoint. I have some notes on a paper here, and I'm welcome to like take any questions maybe, but yeah, I'm definitely a little behind on that.
Well, very good. So just go ahead and talk us through this then. And we're sorry you've been feeling badly.
All right, no, thanks. No, it's all right. So basically, I mean, kind of what Mike was saying with the similar multiple, but with EBITDA. I think the one using EBIT just is because like EBIT already kind of takes depreciation out already. And then some of the conditions, just like with the constant debt to investing capital and revenue to investing capital, I mean, those are kind of, I think, assumed constant. And then, I mean, it was talked about a little bit in WhatsApp in the chat and whatever, but as you were just saying as well, with the one unknown, when you break down the formula algebraically, would be G, and then you can, from what like my understanding is, kind of just anywhere from like between 2 and 3%. But we went over what, and I mean, we know what enterprise value entails, as well as EBIT and all those things. But yeah, sorry, I wish I had more to say, but.
Okay, so Micah, what question would you have for Noah?
So could you just tell me which question that was quickly?
It was 6, the one.
Okay, perfect.
What conditions? Yes.
Yes, let me just pull that back up. Okay, so my question is, like, why is this one more reliable? Like when you compare it to other valuation multiples, like why is, because this one seems to be the preferred.
Right. Yes.
Firm. So why is that? Why is it this one?
I think it has something to do with the EBIT instead of the EBITDA, and how EBIT already may be taking out something for depreciation. But I don't know, it's kind of.
Well, let me help here. So Micah, is it more reliable? I think you use that term, or is it simply preferred?
Oh, I think Rick actually has said that before, that it is the preferred one.
Yeah, it is, but are we correlating the fact that it is the preferred mechanism for evaluation or with it being reliable?
I would say in the research that I've done that it is more all-encompassing of the elements of the firm. And so to me, that would mean that it is also more reliable, because you're looking at EV, which is kind of like what you could purchase this firm for, over its like operating profit. And so I'm like, that's encompassing almost the whole company. So to me, that does seem more reliable, because there's not like other factors that are going to like come into play that we're not noticing.
Well, that's interesting. Noah, do you have anything to add to that before I respond?
It's
okay.
No, not right now. I was
okay.
Please.
So let's think about this. If that enterprise value is synonymous with the estimated value of the company, and it should be and would be, okay? If enterprise value is synonymous with the estimated value of the company, and if the estimated value of the company includes facets of growth, return on capital, cash flow forecasts, all of these things, that would suggest that all of the models are equally as encompassing. But there actually is something in an enterprise value multiple that is brought to bear that isn't in the others. And so maybe it does capture something. And that's when we use a market comparable. So if we apply a multiple to our company's EBIT in order to calculate the enterprise value, and we take that multiple from other companies in the industry that have had transactions, it's like valuing a house based upon comps in the real estate market. So whereas the other models don't bring in any market comparability, the enterprise value multiple does bring in market comparability. So I think in that respect, it might be considered like a little bit broader ranging. So that's interesting. I will tell you though that it's a double-edged sword. We like to think that markets are always right, but we've lived through enough markets to know that that's not always the case. Would we have agreed at the beginning of the year 2000, as the dot-com era bubble was just about to blow up in our faces, would we have agreed that markets were always right? And my guess is, as capitalists, as investors, we would say, yeah, markets are always right, because the economists tell us that they are. And then a month later, when the market had fallen by some 30%, we would have been left with a great big slap on our face, right? Because, well, was the market right a month ago, or is it right today at a 30% spread? So markets aren't always right. So while bringing in that additional market component can be very useful, sometimes we bring in a market component of a market that's not right. Go back to Damodaran for a minute. Think about Damodaran's commentary with respect to why he would or wouldn't have bought, I think it was Apple or Uber or one company you might recall. It's been too long since I've seen the videos. And it's because it was overvalued in the market. So markets aren't always right. There's another element here that I think is worth talking about. And again, this element is critical if you see this question. I would say that the EV divided by EBIT multiple is credible in part because if we rearrange that equation algebraically, we can say EV equals EBIT times the multiple. It's the multiple itself isn't the valuation model. It's enterprise value equaling the cash flow variable, in this case EBIT, times whatever the multiple is or should be. That's where the model lives. And we know that it can be credible because we can take any company's value and divide it by at that EBIT, and we get a multiple. And then we can rearrange that and say if we take the EBIT times the multiple, it gives us the value. In fact, we know that that's how we find the continuing value of the forward market multiple format. And if we think growth is constant for the company, then we wouldn't even bother with the discounted cash flow period. We go straight to this multiple, which reveals one of its weaknesses. It is a broad brushstroke. Just like applying the Gordon growth model would be a broad brushstroke. So why is it so commonly used? Well, Micah, I think you're right. It brings in some market elements that the others don't bring in. But beyond that, it's the most commonly used because it's the easiest to calculate. And people inherently are lazy. In fact, they'd like to take a nap during classes, right? Oh, darn, Brandon, I thought you weren't going to open your eyes. I was going to harass you there for just a half a second more. But people are inherently lazy, and we like to do things quickly. And so that's a lot of why it's used so commonly. By the way, and it might be interesting for you to know, all accredited valuations include both a market multiple form and a discounted cash flow form. So, okay, any other questions or comments here? Do we have Jaden back with us yet? Now, some of us know Jaden well enough to know he's probably having kittens right now because it's killing him that he's not being able to get his technology to where it needs to be. But we're going to move on. Peter, I think you're next with question number 9.
Yep.
Excuse me. That can't be right. Peter, what question number?
I'm question 9.
Okay, good. Right. You know, excuse me for a moment. Okay, we're good. Okay, I had to get my head straight for just a minute here. I apologize.
So this is I had question 9. Question is, we know many firms choose to repurchase their own common stock in the open marketplace. Under what conditions might this type of activity be beneficial to the firm, and why might firm stakeholders support the decision? So the effect of a buyback reduces the number of shares in the market, which then increases the ownership of the company for each of the stakeholders. Companies will buy back their shares if they believe the market has discounted their shares too much, or they believe they're undervalued. And the buyback will make financial ratios look more attractive to investors trying to boost their desire to invest in them. So ROE, ROA, EPS will all increase with the buyback, and the PE ratio will decrease, which is an attractive thing to investors. And then to answer the question, if the company is in good financial standing, in my opinion, a stock buyback will increase the value and demand for the company and hopefully increase their share price. And then I have a little quick example here. So the company is going to buy back 1 million of their shares at $15 a share. So that will decrease their assets, as you can see here, because they're spending $15 million to buy back these shares. And then that will also decrease their shares outstanding. So then you come back over to the equations here. So ROA will increase to 5.71% from 4%. Earnings per share will increase as well. And the PE will drop from 75% to 68% after the buyback. So,
Okay.
any question?
So Noah, I think you're the one responsible to ask the first question here.
So give me one second. Did you just make up the shares outstanding numbers? Or I'm not.
Yeah,
Actually,
all this information you've given us, Pete, you simply created this, right?
right.
Yeah, I found this example on Investopedia, actually.
Yeah, sure.
Yeah.
So,
Well, look, I'm going to give you a minute to think, Noah, and
okay,
I'm going to help us out here for a second, for the sake of time. So there's another element. Peter, everything you said is right. Okay. In fact, you've given a very good and a very classic answer to this question from an investment standpoint. I want to get a little more holistic now, because in our class, clearly we've been investment oriented, but we've been firm centric, right? So we've been a little bit more than just thinking about stocks and bonds. So if you see this question, you've got to give me an answer that also brings into account the concepts of financial engineering. So why might we buy back our stock when our cost of equity capital is greater than our cost of debt capital, and we can either use cash or we can raise debt in order to buy back some of that expensive capital, in which case it decreases our WACC. And when WACC decreases, what happens to the value of the firm? It increases.
Yeah.
Yeah, so financial engineering is actually at the heart of the answers that you just gave. The reason, and go back to that slide if you would please, the reason that this works in a stock example is because of the financial engineering that alters our cost of capital. So the condition that must exist is that RE must be greater than RD. Now you might say, well, what if we don't use debt to buy back the stock? What if we just use some of our cash? Well, that's fair. One of the thoughts of RD then is that we are getting some return on our cash, either through buying treasuries or having money in savings accounts, and that's going to be an influencing factor in our company's cost of debt. So when RE is greater than RD, then our company its value is improved, which means its equity value expands, which is what allows for this kind of activity on our stock, that its value expands because we've decreased our overall weighted average cost of capital, the discount rate. So this is a financial engineering as well as a stock-centric answer.
Okay.
Okay. Anything else you'd like to ask in there or add to that, Noah?
Not really at this time, sorry.
Okay. Hey, so we feel badly that you're feeling bad, and I'm going to hope and trust that you haven't come down with that dreaded virus, right?
No, I don't
Okay.
think so.
Okay.
Thanks, though.
All right. Thank you. All right, Victor, I believe you're up.
All right, I'm gonna start the share the screen. All right, can you see this?
Yes, you'll have to speak up just a little bit for us, I believe.
All right, so I had question number 10, and the question is Nobel laureates Modigliani and Miller have preferred that the value of an asset should not differ based on the discretionary choices of the firm's capital stakeholders. Explain why this may be true and discuss the valuation model inputs commonly used to reflective their expectation. So I wanted to tell you a little bit about the MMM theorem that it's used in financial and economic studies to analyze the value of a firm, also to determine the optimal level of debt a company should leverage to maximize value. The MMM model states that the firm's value is based on its ability to earn revenue plus the risk of its underlying assets. The value is independent from how the company distributes its profits or finances its operations. In other words, the way a company finances its operation should not affect its value. So the MMM theorem, it assumes the following. Firms don't pay tax, perfect competition and perfect information exists. There's no bankruptcy fees, no interest rates, no economic profit. And the value of the company is based off of its future cash flows. So the MMM theory states that a company that uses some amount of debt finances will be more valuable than a company that finances itself totally from equity. And this is because of the tax advances that the tax advantages of deducting interest rates and payments of debt. Well, that equals to lowering the tax liability and therefore making it more profitable than the equity-only company. And a small example to address this is that I would buy that company. My company is being sold. Companies XYZ are interested to buy it. Some tax rate applies regardless of the potential buyer. So the buyers are X has no debt, Y has low debt equity ratio, and Z has heavy leverage. And all of them offers $10, and for me it shouldn't matter who buys it because Z then offers $11, so Z will get the firm. So it really doesn't matter how the firm is structured. The value of the assets doesn't get affected by their structure. And another way to look at it, if we have a shoe production company, and for instance, the M&M theorem says that the value of the shoes doesn't change if we were to, for instance, sell the shoe and then extract the laces from the shoe because there's no extraction fees from the laces. So we would sell them in two parts. They would still be the same value of those two assets that we were to sell. But MMM theorem says that it's the same value. And the MMM theorem demonstrates that being more profitable makes the makes the leveraged company more valuable. And to conclude this is that the reality is that there are interest rates and you have to pay tax. And the value of an asset can also differ based on debt and tax deduction, and this is to some degree proven through the APV valuation model. However, the discount rates differ, and as a result, the model outcomes equal each other. And in simplest form, there is no difference if a firm finances itself with debt or equity. So this is what the MMM theorem suggests to us. And looking at the APV valuation model, you probably remember it quite well, that when we have the two different parts there, that with the tax shield and with the cash flow shield, and the answer there is that when we're looking at the cash flows, they will equal each other, and that's the point of that. But yeah, thank you for listening.
So Peter, what would you have to ask Victor on this?
So you said the leverage company, did you say it was considered more valuable?
Yeah, because yes, they are considered more valuable because they can deduct their interest payments, so they don't need to pay as high of a tax than the equity company, which finances itself by their own equity. So they're not getting the tax advantage as the leverage company is getting. So that's the difference there.
Okay. Yeah. Okay. Sounds good.
So here's a question. Most of our valuation models don't have any reflection on debt or interest payments. So anything that uses a discounted cash flow, free cash flow, the multiple, KVD, even the econ profit model, which you guys haven't really been introduced to, none of those models have any reflection of interest or debt because the variables in the models don't include interest or debt. It's only the APV model that does. So that being the case, and if we value companies on valuation models, how is it that having debt will make the company more valuable?
Can you repeat the last part of the question? You were breaking up a little bit.
Oh, I'm sorry. Yes. So given that most of the valuation models that we're aware of, all but the APV model, have no reflection of debt and no reflection on interest because debt and interest are not part of the variable set included in those models, how is it then that we can say that having debt makes these companies more valuable?
Isn't it because to answer it simply, it's just because we're getting the tax advantage from them. So
okay, and that's reflected in the APV model, right? And we know that we have some discount rates that are used in the APV model, the KU and K-tax, that when they're used properly, the value outcome using the APV model is the same value outcome as the value outcome using the free cash flow model or the FMM model. So in that case, the models that we chose didn't result in different outcomes. But I would agree with you, Victor. I would agree that the company that smartly uses debt is going to be a more valuable company than the one that does not. How come?
Because what they're doing is that they're leveraging their firm to increase their growth with debt rather than with their own equity. So they're not using their equity to increase their growth.
Well, they might be using equity, but they're also using debt to do so, and that's exactly right. And when our company grows, our cash flow grows. So whether the model that we use is expressly a cash flow model or is a multiple model, takes in tax shield or free cash flow or not, if the company has grown, its value has increased. It's not that debt is forcing an increase in value here. It's that the company's managers have used debt to increase cash flows. And it's the increase in cash flow that we see reflected in increasing values within the valuation models that we use. So I think that's an important argument, that needs to be included if you have a question like this. Let me extend this question out just a tiny bit. Because I want to go from, instead of just being the valuation model that that is an influencer here, is there any reason that we should believe that two different potential owners of a company, based upon how they capitalize it, should result in two different values? Or is the way that we capitalize a company not relevant in terms of its value? And are these different questions than each other?
Well, I wouldn't say that they're two different, but capitalizing your company in different way, I mean, it certainly comes with different outcomes, depending on how you leverage your company. Because if you use debt equity to increase growth, then obviously because if we think of WACC, so how do we decrease WACC? Well, in modern theory, WACC is U-shaped, and when we take more debt, the WACC goes down. But if it goes down too much, then we come to a point that we run a financial risk of bankruptcy. So we want to have it in an optimal level. Borrowing too much money, it doesn't make sense either there. So you want to find the right balance. I don't know if I answered your question correctly, but
yeah, you kind of did. I mean, that in concert with the rest of the response you gave us as you were answering the rest of this. But think about this: the valuation model that we use should not give a different outcome regardless of the model. If we're looking at company X, if we're looking at Malmstrom Enterprises, whether we use a free cash flow model, an APV model, a multiples-based model, the value of Malmstrom Enterprises is whatever its value is. And the model that we use shouldn't give us meaningfully different values. Oh, they might give us a slightly different value, which might actually inform the range of acceptable values, right? But there shouldn't be a meaningfully different model or a value here. Just as if Noah was buying a company and going to buy it all cash, so all equity, or Victor was buying a company and buying it half equity, half cash, or Alex is buying a company, buying it with almost no cash or equity and lots and lots of debt, well, they're all the same company. It shouldn't make any difference the capital structure that we're going to use to acquire the asset or the capital structure we put in place for the asset. That shouldn't affect the value of the asset. Now, maybe Victor and his managerial prowess can affect the value, or Noah and his managerial team can affect the value, but how they chose to capitalize it should not. And that's all in part, that's all embedded in the Modigliani and Miller theorems. Okay? Okay, Will, you are up next, brother.
Okay, awesome. I'm gonna see if this will. Let's do that.
Very good. We can see your screen now.
Okay, let me. Okay. Go ahead. Well, let me do okay. There we go. Alrighty. You guys can hear me, correct? Okay, awesome. So mine is the EV/EBIT multiple. It's going to sound kind of similar to everything we've talked about and just kind of give you a good recap on it. So I had question 5. And so it said the firm's ROIC is 13.4%, a long-run growth of 4%, a combined state and federal tax rate on EBIT of 25.95%, and a WACC of 7.9%. What is the resulting EV/EBIT multiple? So here you can see the equation just on the right. And so when you plug it all in, you have you come out with a multiple of 13.19 is the multiple. And so everything in here, you know, we've just plugged it in pretty simple as we've talked about. And so I'm going to talk a little bit about what really changes the multiple. So as we've talked about with the ROIC, with it, you know, no plat, and invested capital tends to grow, especially on your larger firm companies, at the same rate as revenue. So those don't necessarily change as much. WACC, most larger companies, like we said, are between 5 to 18%. And like we said, to change your WACC, you bring on more debt if you would like, and whatnot. So not necessarily that one that can change the multiple too much. And then the tax, unless policies change, you're not going to see that one change. So the end result is leaving us with G. And so G is a much more subjective and more dynamic, just because it is one of more of an assumed variable. So how does this change the variable, and how does it change the multiple? So I went ahead and I applied a 2% long run growth, which came out to have the multiple at 10.68. And then I applied a 5% G, which came out with a 16 multiple. So as we see, this G can really have an effect on what our multiple is going to look like. Just like we've talked about earlier, it is one of those that creates the change in it. And so then the second part of the question is how might you use this valuation estimation? So with it, you can take similar companies in your same industry with similar margins, similar size. You can take all those together and come up with their EV/EBIT multiple, and you can compare where yours falls with that company. You can see kind of where you're maybe lacking, or in what areas you're excelling in. Sorry, I shouldn't have moved this. Okay. And so yeah, that's how some use it, as well as you can just take that multiple and times it by your EBIT, and that will give you an actual valuation of your company based upon your EBIT. And then my next slide here, oops. What does the multiple represent, and why do people use it? Again, like I said, it's just a representation of how that company is doing in their industry, and they can take other companies and see how they're doing. And kind of like we stated earlier, Rick said, why do people use this? Is because it really is one of the easiest models to create, super quick, and just very efficient with it. Like my other ones, when I created, using a 2% or a 5%, it took me less than 2 minutes to create both of those. So it is very simple to use. So that's that.
Okay. Victor, what would you ask Will?
So you talked about taking the industry average and then coming up with the average multiple value. How can you, how in your research, did you find anything about how to look if an industry is overvalued or undervalued?
Well, for the most part, I think to kind of avoid that, or I guess the whole industry, if you think it's overvalued, I mean, I don't know. I know you could see that there would be some, in the sense of, we can take the .com era, for instance. Like any industry that said they were part of the internet was probably overvalued, because they used the word internet to increase their value of it. But we did see that end up coming to a crash. So I would say your larger firms that are more mature and sustainable, I don't really see that as necessarily too much of a problem. I guess modern day, I don't know, one thing I have looked into is if you've ever heard of Virgin Galactic. They're a space traveling company, and they're one of they're very few private or publicly traded companies. And I want to say their multiple on revenue is like 4,000, which is just absurd. So because though that's one of the few, it's hard to say. You could say that industry is overvalued, but again, you're only looking at one company, so maybe it's just that company, not necessarily the other one. But I would say you can see that, and that's when you see them coming crashing down. But for your more mature, I would say they're all pretty, if you take the average, it's a pretty safe number to take, and they're not overvalued.
Yeah, that's a really interesting question about identifying whether or not an industry is overvalued. And I've not thought much about from an entire industry standpoint before. Will, I think your comments are pretty good. I think there's another way you can think about this. Recognize that when we apply a valuation multiple to a firm, we're applying it probably based upon its peers in an industry. And if we simply took the average of that industry and applied that multiple to the specific firm, then we're applying something reflective of the whole industry, right? So I think it's a relevant question, Victor. So here's how I would think about this. Recognize that we're going to always look at assets and we're going to value them in multiple ways. We'll do, so let's say, a discounted cash flow evaluation like from free cash flow. We'll separately do a market valuation from the utility of a multiple. And if we find that our valuation from discounted cash flow is meaningfully different than the valuation from the multiple, and if that multiple is an average of the industry, it would suggest to us that the industry is over or undervalued, but depending upon which of those two values was greater. So I think that that's relevant. Okay. There's only one other item I'm going to add to this. In fact, if you back up, I think go back a slide or two here. One more, please. Okay. So what we've seen here is Will, of course, is using that equation that I had up on the screen for you a few minutes ago. In fact, I'm going to bring it back up because I think it's instructive here. And if you're answering this question, you must use this equation. So go ahead and stop the share so I can start it. And okay, so I think you're able to see this document. And notice that here I've got the equation that Will used, or I think it's down here actually, but right next to it I have this equation, this G solution equation. And that's just rearranging that equation to solve for the growth rate rather than to solve for the enterprise value or the multiple. That's all that it is. So, but if we know the multiple, if we input a multiple into this, we can solve for a rate of growth. And that rate of growth, if it is higher than we think is plausible for that firm or that industry, we would recognize that this company at that rate is overvalued. If it's equal to what we think that is plausible for the industry, we might say, okay, it's not a bad value. If it's less than, then we might say that this particular company we're looking at is undervalued, and we might be yet more interested in the company. But there's something inherent here. When we're looking at this G, and we're looking at it in what is referred to as a single stage model. So if I take this, it is a single stage model. I'm just looking at enterprise value equals EBIT times a multiple. That's a single stage value. We're not looking at a present value of a discounted cash flow and a present value of a continuing value. That's a super simple number that we're coming up with. And it could be flawed because it's generalizing all of the growth for all of the future. So you've got to be careful when using one of these. You're right, it's popular, it's often used because it's so simple, but its simplicity, while bringing in a market construct, as Micah pointed out, its simplicity is a little misleading to us. It's also really easy to get wrong. Okay? All right, let's move then to Shenzhen. I see that you're with us, Shenzhen. Are you going to share? There you go.
How do I share my screen?
You should be able to share your screen. You should have a green icon towards the bottom of your screen that says share screen.
Share.
Well, you just did it. Good for you.
Oh, okay. So my question is, 1 second. So my question is, we understand that under some conditions, KU equals K tax in the following equation, which is under that, and under other conditions, K tax equals to KD. So what are those conditions, and what is the inference when KU equals K tax or when K tax equals KD? Next. Right here. Okay, first one, the KU equals K tax. And we know KU is unlevered cost of equity, and K tax is the cost of capital for the tax shield or discount rate associated with paying taxes. And as KU is similar to WACC, it can represent the cost of the firm issuing stocks. So for example, when there's a firm with no debt, they don't need to pay interest for debts. They only pay dividends for stocks. The next one is K tax equals KD, and KD is cost of the debt. For example, when government needs money, it will issue debt, so it can be viewed as RD. The opportunity cost, which has the same effect of acquiring tax. So next is it's the equation stuff. So the levered cost of equity KE is related to the unlevered cost of equity to the following equation, which is the equation we saw earlier. If we assume KU equals K tax, the final terms KU minus K tax right here disappears, and the equation will be the rest of them without this. If we assume K tax equals KD, the equation will be like this if we do the algebra, the thing. So that's what I got. What I get for the for the stuff here.
So so before you ask a question, Will, let me tell you that I had not intended to have left this question in the study guide. I had taken questions 8 and 9, which were both about this this equation and this APV construct of costs, and I had removed them on my version of the study guide, but I'd neglected to upload that version to the web. So what you were looking at and what I had were different when I made the assignment. So when I realized this, I reached out both to Peter and to Shenzhen, and Peter was willing to go ahead and change the question to the one that he addressed for us. And Shenzhen had already gone ahead and started to prepare this and was willing to go ahead and tell us about this. So Shenzhen, thank you for doing that. This is the item that you guys probably have the least preparation on. So there's a couple of things here that I want to make sure we're very clear on before I turn over to Will to ask a question. And that is what KU means and what K tax means and what KD means. So KU is the cost of unlevered equity, exactly as Shenzhen has told us. And K tax, we have to think about that as the opportunity cost of us paying taxes. Well, we have a problem when it comes to this because some of you are fine paying taxes. You don't mind it. In fact, you believe it's your obligation, right, etc. And some of you probably resent paying taxes. So depending upon your political ideology, and I'm going to suggest that what I just indicated is a reflection of your political ideology in some respect. So depending upon your political ideology, it will cause you to either value or more or less the payment of tax, which means you have a higher or lower opportunity cost and a discount rate that you might apply if you ever thought to do so. So that makes it such that K tax for Will might be different than it is for Micah than it is for Martin, because of political ideology coming into this thing, and it's not very clear cut. KD is pretty simple. And just exactly as Shenzhen has told us, we think of KD as the cost of debt. And we will sometimes say that KD equals K tax because, as Shenzhen said, when a government doesn't have enough money to pay expenses based upon tax receipts, it'll borrow money. So in lieu of tax, it borrows. So there's a relationship there. We will connect those two. But KU is a problem. What does KU represent? Well, it's the cost of unlevered equity, right? Well, that's easy. K tax is a problem because political ideology gets in the middle of this deal, and we might consider it differently. KU is equally as big a problem because it's the cost of unlevered equity. Well, show me the company that has common stock trading in the market, equity in the markets, and show me the company where there's no leverage that affects that stock. So the capital structure we were talking about a little bit ago, they have direct bearing here. So even the company that is trading in the market with its common stock, its performance is a function of how much debt they employed, the dynamics of the cash flow. We already argued that point. And so KU is wholly theoretical and non-observable. In fact, that equation that Shenzhen have put up here for us, we can rewrite this equation. I wouldn't ask you to do so. It's gnarly. You can rewrite this equation to solve for KU.
So I got the stuff. I just need to pull up another PowerPoint.
Oh, great.
Wait, one second.
So when we see this, we can solve for KU because KD, or rather KU is wholly theoretical otherwise. And the only way to find KU is to reverse engineer and solve for it. Here we have the unlevered example. Good. Okay, with Will, anything you want to ask, or get out of our friend Shenzhen on this?
With it, I mean, I don't know. There's a lot there.
It's okay if you don't, because A, there's a lot, and B, it's one of the things you were prepared the least to deal with, given how we've allowed the class to progress.
Yeah, I don't know if I have really any.
Okay. I will tell you, to the extent that you see this question, I would be expecting an answer that would talk me through what those variables mean and would talk me through, just as Shenzhen did, the equation and what happens when KU equals K-tax versus KU equals KD equationally. And then talk about this issue of KU being fully theoretical and K-tax being so subject to ideology.
And Rick?
Yeah.
Christian, is KE, is it the cost of equity?
Yes, thank you. KE is the cost of equity. So if we're reverse engineering and solving for KU, we would substitute for KE, we would use RE, because cost of equity, KE, cost of equity, or return on equity, RE, same thing. And for KD, we're going to substitute RD. It's why we can go ahead and reverse engineer this and solve for KU, because we have substitutes for KE and KD. Okay. All right. Well, we have been waiting for an hour and 20 minutes for this treat. Jaden, you're up.
Hold on. Let me share my screen. And it's going to work this time.
There you go.
Look at that. Okay. Hold on. How do I move this thing to actually present?
Well,
Well,
go to the bottom bar.
oh yeah.
And you see this. There you go.
Okay. So I had question 2. And so we'll just go on to what that is. So question 2 says, when might the value of free cash flow, which is the following equation, result in a why might, not when, why might that result in a different outcome than the value for key value driver? So going to the next screen, I just broke this down and started by finding how they're similar and then variations. So both of these equations are just different variations of the structure of a present value of discounted cash flows plus a terminal value discounted to continuation period 0. And so if they're the same base equation, the key is to find variations. So the first part of both equations are identical, as you can see here in the bottom. They both are the sum of free cash flow, the sum of discounted cash flows. So if we come to the next one, this is the second half of each equation, and the parts highlighted in yellow show identical stuff. And so the entire difference between these two equations simply lies in the fact that the free cash flow model just uses free cash flow 1, while the key value driver model uses the KVD form of free cash flow, which is NOPLAT times 1 minus growth over ROIC. And so, yeah, this is an unnecessary screen. Okay. So if we go to the key value driver equation, like I said, it's the NOPLAT times 1 minus growth over ROIC, we can see that that's equal to free cash flow. Turn to scale. Okay, and then so I just kind of go through here that when we forecast the last screen for the free cash flow, it's just we're simply forecasting into continuation period 1, and then we're solving for free cash flow. And so what I note here is the fact that when we're using this equation, we're using the exact same NOPLAT that we used in calculating free cash flow, and we're using the exact same ROIC, because at least everything we've done so far has assumed a constant returns to scale. So we're using the same NOPLAT and the same ROIC. Therefore, the difference must lie in the G that we can solve for free cash flow. And so if, I hope I'm making sense here. There was a lot that went into that, but so when we're trying to figure out how the G is different, one thing that we actually did this in one of our problems is we can take our forecasted free cash flow and we can rearrange it using the key value driver model to solve for G, which is this part right here. So this is just the rearrangement of the key value driver model to solve for G. And so whenever we're doing a problem, what ends up happening is the G that we calculate here, which we calculate for the forecasted free cash flow, so the free cash flow used in our free cash flow model, is going to end up being different than the G we assume for our key value driver model. If that made any sense whatsoever. And so that's just the end conclusion here. Basically, they're identical, and the only difference is when we calculate free cash flow, we're assuming a different G than the one we use in the KVD model. And so.
Okay, so I have a real quick question for you before Shin-Jin would ask one, and that is, go back to your equation, the G equation right there. Are you confident that that's algebraically the right equation?
I thought I was, but based on your
did you work it yourself, or did you find it in some book?
I calculated that myself.
Okay, all right. I've never tried to reverse it like that. So what you guys might have noticed I was doing is I leaned in as I was starting to work the equation. So it may well be the right equation.
Well, isn't that that's what we did, and that's what you did in one of our problems.
Okay. Well, well, good for me.
And I based it off of that to make sure I did it right. So
good. All right. I just hadn't recalled having done that. Okay.
Yeah. Sorry about that.
So no problem at all. In fact, I like that you brought this out for us. So Shin-Jin, what question would you have for Jaden?
Actually, that equation rearranged, that was my question as well. And other than that, I don't think I have any.
Okay. So this, of all of the questions we've dealt with in this study guide, this is probably the one that we've answered in class the most often, and the one that we probably answered first, because we came upon this issue of free cash flow equaling NOPLAT plus depreciation minus change in net working capital minus net capital spending. We came across that very early in the semester. The only thing I would add here, and if you did this, I didn't notice as I was trying to calculate something else, Jaden, I apologize. We might put together those two equations. So the NOPLAT plus depreciation minus change in net working capital minus net capital spending being equal to NOPLAT times 1 minus G divided by ROIC. Well, and see them as an equality. Well, unfortunately, when we do that, one of them is summative and the other one is a product. So we can't just easily and neatly start to cancel out terms. It'd be nice if we could. But we can think of it conceptually. And remember that when we put this together, we're selecting a G. right? Where it's a long-term G, and it's an explicit period G. It's what we're selecting a G. We're not using one we found and calculated or observed. We're selecting one. And when we do that, we risk it being different than what might be observable in the other side of the equation. So the traditional free cash flow side of the equation doesn't have G in it, does it? But the KVD side of the equation does. Well, can we see any G in that one on the free cash flow side? Jaden, you don't have the free cash flow equation on your spread or on your PowerPoint, do you?
No.
Okay, let me bring it up real quick. Go ahead and release the screen to me, and I'll bring it up in one of our quick sheets. Okay, you should be seeing my screen 2 now, I believe. Are you seeing my corporate finance quick sheet?
Yes.
Okay, good. All right, let me scroll down here to free cash flow, so we highlight the equation. And I want to spend a second on this because we've dealt with it before, but because since it's been such an important element of the class, there's a pretty good chance you'll see something like this on the exam, right? So notice here that we've got these two equations. This is the one that's on the right-hand side, let's say, if we're putting them together. This is one that would be on the left-hand side if we're putting them together as an equality. And we can't just start canceling out terms like we might like to. But I think we would argue that no plat is active in both sides of the equation, not as an operative, but as a function perhaps. And in this ROIC, we have some relationship between no plat and invested capital, and we have G then separately. Well, is there any inference of G in this upper equation? And I would say that there is. I would say when net working capital is changing, it's changing at some percentage rate, and that's a growth rate. If it's getting smaller, it's a shrinkage rate, but that's just negative growth. It's a growth rate. Anytime we see a change, we can boil it down to a percent change and call it a growth rate. And in net capital spending, we're looking at fixed assets from time 1, minus fixed assets from time 0, plus depreciation. Once again, we have growth reflected in there. So I would say that one of the reasons that we can think about these as both being the same equation is because they are affected by the same functions. That said, they yield different outcomes. And exactly as Jaden told us, they yield different outcomes largely because of that G. We select the G. And when we don't select the G, when we've calculated it, if we were able to calculate it, we'd probably use the same period of time that we calculated the traditional FCF for, and we end up with the same kind of response. But when we input one by having said, well, we believe our long-term G should be 2 or 2.5 or 3%, we're going to come up with a different outcome, which is why the KVD form of free cash flow is only used in the continuation term and only used in the KVD model. Does that help a little bit?
Well, and to that point, one thing when I was doing this problem I struggled with is I was saying, well, if our forecasted free cash flow assumes a growth rate of 3%, and if that's the growth we use in KVD, why are they still different? But this is overly complex, but I just went back and realized that the original or base year had a different growth rate, and then it's just growing at a constant rate, so right. The difference remains consistent.
Yeah, the growth rate that we see when we calculate is the growth rate of the year from which we calculated, which typically is the base year. And we have to think about what the base year grew from to get to where it is, and that's a different rate of growth than what we're projecting into the future. You're exactly right. Okay, so I don't have new concepts that I want to put before you, of course, and we've gone through all of our questions, and I'm trying to see how I can unshare my screen now, and it's not happening for me. How do I get this thing to unshare? There it is. Okay, so before I let you go, any questions about what I'm expecting with the exam on next Monday?
I know you already said this, but just to clear it back up, we don't need to get that lockdown browser.
You do not need lockdown browser. You will, at the appointed hour, so 10 o'clock straight up, is when I will have released this exam to you guys. And you'll have from 10 o'clock until 12 o'clock Utah time to provide your answers and submit them to the assignment. So you're going to be submitting from within Canvas. So at 12 o'clock, you're going to be able to open up the exam, and you're going to find that there are 4 or 5 questions. And they're simply going to be on a sheet like the review sheet. And you then will have the ability to not type into Canvas, but to answer those questions in an MS Word document. And as you do that then and have saved it, you submit that document to the assignment in fulfillment of the assignment. If you don't submit it by the appointed hour, you're done. So make sure that you aren't submitting late, because it won't accept it after 12 o'clock, okay? And I know some of you guys have classes to get to and such, and so we all need to have the same kind of time frame here. So be careful and don't find yourself late in submitting this thing. If I were you, I would absolutely use equational structures, but you're welcome to simply copy those from the documents that you're preparing as your solutions, and you can copy them from my quick sheets and anything that you've copied that you have accessible. The reason you have all the quick sheets and the problem sets as DOS, or rather MS Word files, is so you can copy the equation into another MS Word file, okay? I don't want you to save these as PDFs and upload a PDF. I want you to upload the MS Word file, okay? And it's not a shareable, linkable thing, the actual file, okay? And I would just tell you, be as complete in your responses and as well structured in your responses as you can, and manage your time. If you come in and you see 5 questions, or rather, let's say if you see 4 questions, know that you really can't afford to spend more than half an hour on each one, because you're going to use up your 2-hour time budget. So give yourself a budget, stick with that, and then if you finish early, then go back to a question that you might want to elaborate on a little bit more, but don't find yourself running out of time, okay? Any other questions?
With the structure of the answer should be a little bit like what we did on the PowerPoint, but with more, I mean, obviously more text than.
Yeah, good question. Martin, I think that they need to be complete. So when I do PowerPoints, you'll notice that I put up a PowerPoint and I will use everything on there, but I don't read the PowerPoint. In fact, my PowerPoints are just kind of like bullet points, and they're like my index cards to remind me. And I will speak through and discuss through the answers. Some of you guys are a little less comfortable doing that, so the entirety of your answer was on the PowerPoint, but some not. So I would tell you that however you want to do this, you've got to give me complete thoughts. And I would say that you're probably better served in typing this out as though it were prose. But I'll leave that up to you. Make sure you give me complete thoughts. You don't want me to wonder what your answer is, because I can't find it in this sea of bullet points that haven't been brought to a conclusion or a finite response.
But I guess my question would be more like, can it be in form of a bullet point, but even if it's complete, just to spare some time, just like super efficient bullet point and just straight to the point?
It can be. This is not a paper. This doesn't have to be elongated prose. But make sure, if it's a bullet point, that it's clear to me that you're giving me complete thoughts, complete response, and I know what the response is. I only say it like this because I've actually had a student in the past who's graduated now. You probably don't even know the student. He loved to do everything in bullet points, but he knew the connective tissue between the bullet points, but I didn't when I would read them. And he's a really smart student, and I could never get him past that. So just be careful with this. Any other questions?
We didn't go over 15 and 16 on the study guide. Are those still fair game for the exam?
Thank you. Well, if you think about it, we actually did explain the concept of production value, but we did it from within the framework of somebody else's question, okay? And yet someone else explained the enterprise value equation and in fact went through and gave it to us. These are probably the two easiest questions on the deal. So you're right, we didn't expressly address them, Megan, but I believe we have answered both of those as we've been going through these. Do any of you have any questions about these? Number 15 is explain the EV equation. In fact, I'm not going to share again. It's explain the EV equation and what is meant by a firm's enterprise value. And then number 16 is explain the concept of production value. And I think we've hit both of those elements nicely from within some of the other questions. But do any of you have questions about those two questions? If you saw something like this, it's probably important that you remind me that enterprise value has an equation, but it's also the value that we're estimating. Okay? When we estimate a firm's value. Okay? All right. Will?
Yeah, this one's not necessarily about the test, but just the groups, the valuation groups. When do we find those out?
Got it. So honestly, I haven't spent any time on that yet. I will address that either today or tomorrow and send something out to you and elaborate on that assignment a little bit more then as well. And then on Monday of next week, we're not going to be together at all. There is no Zoom next week, right? At 10 o'clock, be on the exam. At 12 o'clock, be done with the exam. And then we'll reconvene the following Wednesday. We'll talk more about this, but I'll give you more information in the interim as well. Okay? And remember, it's going to take me a little while to score these. I will read everyone's responses to all the questions, and that way I get a sense of the most elaborate, the most high level response, and as well as maybe the weakest or least complete response, and that lets me then form a grade range. And then after having read all of them, I go back and read them again and apply scoring. So it takes me a little bit of time to score this, so it'll be a bit before you get it back. My guess is you don't have it back for at least a week, at least. Okay?
And
Then,
one last question.
Yes, Martin?
About the submission, that so we have that time frame, but if we feel like we're going tight into it and we still want to elaborate on something, can we submit it twice, or is it once we submit it, it locks down?
I believe, Victor, that if you submit to the assignment and stay in it, which you can do, then you can submit again, and it'll overwrite your first submission.
Right.
I'm like 99% certain of that. Martin?
Yeah, the PowerPoint, I think you wanted us to submit it, but there's nothing, no Dropbox to submit it. So I was just wondering.
Thank you. I will, I'll update that. So I'll go there even as we speak. Okay, so I will update that. All right, guys. Well, look, you've got some goodly amount of time that you've worked on these already and that you've got in front of you. I'm looking for thoughtful responses on this because you've had so much time and you have access to all of your notes and everything while you're answering. Okay?
Okay.
All right. I will, I'll see you on Wednesday, and we may even be talking between now and then. All right?
Thank you.
Have a great day.
You too.
Bye.